Private markets are growing fast, but what do they actually mean for everyday investors? And why are they becoming harder to ignore? From infrastructure and private credit to widening accessibility and generational shifts in wealth, the space is evolving rapidly, and investors of all kinds are taking notice. Welcome to The Bid, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Pulido. Today, I'm joined by Cameron Joyce, Head of Research Insights at Preqin, a part of BlackRock. Cameron has been studying the trends shaping private markets globally, and today he shares what's driving growth, why access is expanding beyond institutions, and what investors should watch as we look toward 2030. Cameron, thank you so much for joining us on The Bid.
Thank you.
Cameron, private markets are a topic that are getting more attention. It's something that we've covered with some of our guests on The Bid and in some recent episodes. But I think for a lot of people, it still feels like a segment of the market or a topic that is a bit of an insider's world. And there's more to unpack there. So tell us a little bit about how would you explain private markets to those that are still learning about it and where it fits in an investor's portfolio?
Private markets, simply put, are investments into companies or assets which are not listed. That's really the simple definition. So that could mean a private company that hasn't gone to the stock market. It could mean an infrastructure asset. It could mean a real estate deal that isn't listed and it doesn't trade. The universe of investable options in the private markets is huge. So for every listed company we have on the stock market, for every Microsoft and Google, you have a significant number of private companies. Now, not all of those are private equity backed, and there's an increasing number of assets coming to the market, and private market investors are gaining access to those. We've seen this continued trend of companies staying private for longer. And that's a notable trend that's been playing out for quite some time, and it's continuing. If anything, it's intensifying more so. And I think the reason is that traditionally, if you are a small growing company and you need capital to scale, in the past you were going to the stock market, you were going for an IPO, you're possibly issuing corporate bonds after that as well. But now what we're seeing is that actually the ecosystem within private markets is substantial. So there's a lot of private capital firms from everything from that very early stage venture to growth equity to large buyout as well that are providing capital for private companies. And that's something that means that these companies can stay private for longer. And actually, a lot of the value creation is still taking place in the private markets. What does that mean for portfolios? Well, what we've seen in the institutional investor space is that allocations have been increasing quite substantially. Your typical investment portfolio for institutional investors is already closer to that 50, 30, 20 allocations, so 20% going to alternatives. And now we think that increasingly individual investors are looking to do something similar, depending on their circumstances.
And so you mentioned private markets are sort of assets that are not listed, and that could be real estate, it could be infrastructure. You also mentioned individual investors as a sort of client segment that perhaps is looking to allocate more. And we've actually recently talked to Jamie Majera on The Bid, where we talked about the retirement landscape in the US and the possible introduction of private markets into retirement portfolios. So there's definitely a lot of talk of the growth in private markets. If you're an investor who's historically invested in public markets and still have a meaningful allocation there, what does that growth in private markets really mean?
Firstly, let's put it into context. So as per the most recent Preqin forecasts, we're expecting $32 trillion worth of alternatives AUM by 2030. So that's a significant increase from what we've seen in the past. I mean, if we go back to the pre-pandemic era, it was closer to 11 trillion. So that's a huge increase over that time frame. If we look today at the total investable universe across public and private, at Preqin, we estimate that the amount of that total, which is private, is about 5%. So even though we've seen that phenomenal growth, it is still relatively small in terms of the percentage of the total. In terms of what that means for individual investors and retirement accounts, there's definitely a portion of most portfolios that can afford to be less liquid. You can expect to earn a higher return over time based on the historical performance that we've seen from these asset classes. So that's one of the key attractions. It is also providing increased diversification benefits for portfolios. So you're accessing different parts of the market, which are providing different return profiles, and that can be an attractive option from a diversification standpoint and and a means of generating lower correlation across the assets that you have in a portfolio. Another key component to allocations from individual investors into private markets is the increased access that we now have, given that there's a proliferation of new vehicles coming to the market to facilitate this demand from individual investors. So historically, if we look at how private markets have operated, they've had these very traditional drawdown fund structures where an institutional investors will commit an amount of capital, and then the manager will call that capital over time as they find deals to invest in. That has worked very well, but for individual investors who are managing portfolios, it can be very challenging to manage those cash flows. So what we've seen now is an increased number of open-ended structures coming to the market, which behave a little bit more similar to what we used to in public markets, and that's why we're seeing more demand and appetite for those vehicles.
I want to go back to something you said about the growth in private markets, and you threw out a couple of numbers. One was 11 trillion, which I think was the size of the private markets maybe just a few years ago. And then there was 32 trillion, which is where the size of the private markets are going. That's the forecast here in just a few years. When we talk about private markets, I think one of the categories that often gets a lot of attention is private equity. At least that maybe for many people was that first introduction, or is the first area they think about. And private equity goes through its cycles, just like all markets go through cycles. Where are we in the cycle of private equity? And if the cycle is changing, like how do investors know when we're at the beginning of a new cycle?
So that's a really good question. I think we certainly have had a very strong cycle over the last 5 years or so. I mentioned the figure before the pandemic. Of course, when we had the pandemic, we had a very short-lived correction in public equity markets, and then we saw a huge stimulus response from authorities, both fiscal and monetary. And what that did is that really accelerated the pace of activity within private markets, including private equity. So we saw a huge amount of fundraising that led to dry powder that was sat in private equity funds. That led to a lot of deal making. And those deals were being carried out at relatively high valuations compared to history, because interest rates were low and there was a lot of a very strong availability of capital. Since then, we've obviously seen the policy responses from the Fed. If you remember back to 2022, we saw one of the sharpest increases in interest rate policy that we've seen pretty much ever when you consider the size of the financialization of the economy today. What that has done has really slowed down the pace of activity. So we've started to see softer fundraising. We've seen deal flow has held up reasonably well, but one of the challenges in this part of the cycle right now is that exit volumes have been more challenged. So that is the ability for private equity managers to exit their positions, because they're looking at the market conditions today, that they're not finding the exit opportunities that they were hoping for, so that they're holding on for a bit longer for better conditions, which is to some extent exactly what you want a manager to do. You want them to realize the best exit they can for your investments. So what does that mean? So interestingly, if we look at the historical relationship between fundraising and the performance of private equity funds that were launched during those times, we actually see a really interesting relationship. So if we go back to the GFC, if we go back even further to the post.com era, we can actually see that there was a contraction in the amount of capital going to private equity funds, but actually they were the best funds to invest in based on the historical data that we have. So in other words, there's less capital going into those vehicles, there's less competition for those deals, and actually the managers have been able to generate higher returns over that period. So I think obviously looking at history doesn't say anything about the future, but I think it's quite an encouraging trend, because at the moment we find ourselves in a relatively challenging scenario with fundraising. But actually, if history had anything to go by, that would suggest that it's actually a very good time to be deploying capital, particularly to private equity.
So let's then switch to infrastructure, which you alluded to before. And we've talked to people like Balf Morrison, who actually invests in more of the public infrastructure assets, but he was quite constructive, I guess that's probably the operative word there, on the space. Of course, Larry Fink has talked about it in his letter to shareholders over time about the growing opportunity in infrastructure. So things like data centers, utilities. Why is this an area of interest, and how can investors benefit from this, specifically as it relates to in private markets?
Yeah, so as you allude to, I mean, I think the opportunity set within infrastructure investments has grown massively. So I think there's been a lot of talk, obviously, about digital infrastructure right now, given where we are in the AI boom that's taking place. So obviously, lots of data centers need to be built, that they need to be financed, and there's opportunities for investors to play a part in that through through infrastructure funds, but also the power for those data centers is going to be. The power demands is going to be huge as well. And then, of course, we haven't talked about the ongoing reshoring trend as well with what's happening with global trade patterns and investments that are being made into reshoring certain parts of the manufacturing process. So the demand the demand for new infrastructure is absolutely huge. And I think traditionally, I mean, if we look at how infrastructure has typically been financed, we see roughly an 80-20 split between governments who are backing these investments and a 20% split for other types of investors. I think what's changing now, though, is that you're starting to see, firstly, more access. So more investors have access to have the possibility to invest in these asset classes. But also, I think the other key thing is the fiscal constraints that a lot of developed economies are facing right now. So as government fiscal balances are more challenged, I think that there's really a push for the private sector to come in, and that's where private markets can really play a role in financing these investments.
So we've talked about private equity, and you talked about the cycle that we're going through there in that space of private markets. We've just talked about infrastructure and the investment opportunity that is manifesting. Let's talk about private credit, which is another sort of subdivision of private markets, and this is where you have lending done by investors rather than maybe more traditional banks, where the banking sector historically played a big role. Now you have, other investors, private investors that are stepping in. Talk more about the investment opportunity in this segment of private markets. What trends are you seeing there?
So private credit is a really interesting asset class. I mean, I think along with infrastructure, that's where we're seeing the most positive sentiment. And this has been the case for quite some time, but we think that's going to persist going forward. And it's due to a number of structural drivers. I mean, we talked firstly about interest rates. If we look at one of the core strategies within private credit today, it's direct lending. So that is a relatively straightforward concept. It's as you say, it's private credit funds making an investment into a company directly. A lot of the time, it's floating rate as well. So in the current macro conditions that we have, with interest rates going up, at least in the last few years, that's been very attractive to investors, so that they've been able to earn a yield pickup when actually fixed income investments have been selling off because of the duration that they have. So that's something that private credit, direct lending can offer something slightly different to a portfolio for that reason. And typically as well, when you invest in direct lending strategies, you're actually earning a premium over what you would if you were investing in the equivalent space in fixed income. So that yield pickup is also attractive, especially if you are at a stage of the market where you're feeling a little bit more conservative with your allocations and you want to reduce risk away from the higher end of the risk spectrum, like private equity or venture capital. So that's some of the reasons why the investor interest has come through for the asset class. But if we look at the evolution of private credit over time, it really has changed. So if we go back 10, 15 years, the space was very much defined by distressed credit, which is a very niche but very interesting strategy. Special situations as well, mezzanine financing as well. So lots of different types of strategies within the private credit space. But more recently, we have seen that proliferation of direct lending. A lot of this is actually related to private equity. So when private equity deals are done, there's an investment opportunity because those deals need to be financed. So typically, a private credit firm may offer something up as part of that deal. So that's really that's the direction of travel, and I think that as we go forward and we start to see continued interest from individual investors, from retirement accounts, I think that private credit has traditionally been seen as one of the first asset classes that those investors are going to, because it's relatively easy to understand. It's a return enhancer, it's a diversifier, and I think that's set to continue as well.
And Cameron, it feels like almost every conversation we have on the bid in some way, shape, or form involves a discussion around artificial intelligence. And you've talked about how you can invest in that theme through something like infrastructure because you need the data centers and the power for those data centers to make artificial intelligence sort of come to life. But what are the other impacts that it's having on the private market space?
I think it's really profound. I mean, I think over the next decade or so, I think we all acknowledge that AI is really going to be transformative to the global economy. It's going to have an impact on pretty much every sector that we operate in. I think that if history is anything to go by, it is quite challenging to determine, where that value creation will accumulate. If we look at the comparison of the dot-com era, for example, there was a lot of speculation in stocks in the late 90s. Some of which ended up doing okay, some of which didn't so much. We look at the public markets today, you might actually have parallels in some instances for that. So I think when it comes to artificial intelligence as well, you mentioned infrastructure, which is absolutely key. I mean, that's one of the key investment opportunities as well. But we've also got to look at venture capital. I mean, venture capital is making some of the more higher risk, higher return bets on where AI is going to be successful and which companies are generating this technology to implement. And then, of course, when we look more generally at private equity, I think the benefits there will be different again. So there will be traditional, real economy companies who are successfully innovating with the use of AI technology. So they may not be technology leaders in the space, but they're doing what they do more efficiently. They're boosting revenue. They're generating higher margins, and they're stripping out unnecessary costs as a result of that. So I think our conviction is that of that value creation, wherever it takes place, the likelihood is that a disproportionate amount of that value creation will be from privately backed companies for that reason. So again, we talked briefly about why that might be, because if you're a small, innovative, fast-growing company that's successfully using AI to boost profitability, you've got more options available to stay private for longer. You've got the venture capital firms if you need them. You've got the private equity firms. You've got lots of investors who are willing to provide capital for the long term, and you're also avoiding that distraction of being listed and having those quarterly earnings results to look after as well.
Cameron, we started the discussion acknowledging that private markets is a popular topic. It's become more top of mind, but that for many investors, it's still an area that maybe is a bit opaque. It's still a lot of terminology that maybe people don't understand, but I think what you've done today is try and bring a little bit more transparency to the space and help us understand some of the areas of private markets and maybe some of the areas going forward that people are going to be able to access this. Thanks for bringing that transparency, and thanks for doing it here on The Bid.
Thank you.
Thanks for listening to this episode of The Bid. Next week, I'll be speaking with Gargi Pal Chaudhry, Chief Investment and Portfolio Strategist for the Americas, and we'll be answering your questions. Got a question for Gargi about markets? Email us at thebid@blackrock.com.